The French yields fell and the euro rose following the final tour of French election. Investors' focus is now shifting towards the Federal Reserve Chair Jerome Powell's semi-annual testimony before the Congress today and tomorrow, and the US CPI update that is due on Thursday, and finally, the big bank earnings in the US on Friday. So welcome. This is Swissquote's Daily Market Talk. So sentiment in European equities was mostly mixed on Monday. Most of them, including the British big caps, closed yesterday's trading session in the negative. The French CAC 40 underperformed its European peers with a 0.63% loss in the session after an attempt to the highest level in almost a month on, while worries that a political gridlock in France from now on would complicate the political picture and make things slow to move in France. But the French 10-year bond yield ease on easing worries that Mr. Jean-Luc Mélenchon could not spend as much as he wants to spend if he doesn't find allies in a divided parliament. Hence the yield spread between the German and French 10-year yield just settled below the 70 basis points yesterday, and the euro-dollar found support above the 108 psychological level and should gently shrug off the weight of the French legislative election, as the French political shenanigans, the French political chaos will likely have a decreasing impact on market valuations. So that means that, we could see the euro-dollar gain further positive momentum from the actual levels this week, especially if the US Federal Reserve Chair Jerome Powell delivers a dovish speech before the Congress this week, between today and tomorrow, and if the latest CPI update from the US on Thursday comes in sufficiently soft and ideally softer than expected by analysts. So that brings me to Jerome Powell and his semi-annual testimony that will start today and will last 2 days. So generally, the first day of the testimony is always the most important day, as we will get to catch the overall tone and the key messages today. So some expect Jerome Powell to sound quite cautious regarding the progress on inflation and tell the US politicians to be patient until the Federal Reserve gathers enough evidence that inflation in the US is on a solid path toward their 2% policy target. But there's also a chance that, he sounds slightly more optimistic and willing to cut the interest rates sooner rather than later this year, pointing at the slowing economic growth in the US and, this loosening jobs market also, which will eventually help cooling inflation further. So the US 2-year yield, which best captures the Federal Reserve rates expectations, sank below the important 4.70% support last week following a softer than expected jobs report, remember, from the US, and needs a sufficiently dovish talk from Powell to consolidate and further fall. The market expects 2 interest rate cuts this year from the Federal Reserve, with a rising probability assessed to a September rate cut. So if you look at the activity on Fed funds futures, we see that the probability of a September rate cut in the US now approaches the 80% mark before Jerome Powell's testimony today, while the US dollar index is actually under a downside pressure since the beginning of this month, and could further fall with a dovish message from Powell today and tomorrow, now that the safe haven flows into the US dollar due to the French political risk are behind us. And at the current levels, while the US dollar index is still in the bullish trend that has been building since the start of this year due to the retreat that we saw in rate cut expectations, the critical support to this year's positive trend in the US dollar index stands at 104.20 level, which is the major 38.2% Fibonacci retracement on this year's rebound. So a fall below this level should send the US dollar index into the medium-term bearish consolidation zone and support the major peers against the US dollar as a result of it. But again, Again, for that move to materialize, so for the US dollar to fall, we need a sufficiently dovish Powell and ideally softer than expected inflation print on Thursday. Now, I'm sure that you heard the talk that maybe, but just maybe, the fact that inflation in the US took so long to ease is because higher interest rates boosted inflation. So that theory exists, especially for Japan, but I wouldn't go that far to understand why inflation in the US didn't ease as much as expected, because there's still this big elephant in the room. That's the huge Federal Reserve balance sheet. I remind here time to time, and the fact that the major US indices run from record to record every single day, and Americans are very well invested in their stock market. So when you look at the S&P 500 and even at the Russell 2000 index, well, you do not necessarily see an urge to cut the interest rates in the US, truly, because the forecast for 12-month forward earnings stand at an all-time high level, according to Bloomberg News. The S&P 500 companies are expected to, deliver more than 9% EPS growth in the second quarter of this year, and this number is expected to rise to double-digit territory later this year. And even the non-technology names are seen posting a positive growth later this year. So what could go wrong, right? Well, one thing that could eventually go wrong is that, these expectations, the EPS expectations may have gone well ahead of themselves, and they are increasingly diverging from, the actual economic data. Because Atlanta Fed's GDP Now index now predicts that the US economy may have grown around 1.5% in the second quarter of this year, and that's down from above 3% the last quarter of last year and around 5% the quarter before that. And the second thing is, the valuations, especially for the big technology stocks that carry the major US stock indices higher since a while now, went through the roof. Nvidia, for example, has a PE ratio of around 75 today, while the S&P 500's PE ratio is just below the 28 mark, and that's about the long-term historic average, except from crisis times like the dot-com bubble, for example, or the global financial crisis or the pandemic time. So something must give, and a correction will certainly kick in one day, but we just don't know when and what would be the trigger of a downside correction. But we know that lower than expected earnings reports could be that trigger to the downside. And the higher the expectations, the harder they are to beat, and the higher the chance of a disappointment in these earnings, and higher a chance of a correction. Now, the earnings season is just around the corner, so we don't have to wait too long before finding out the answer. The big US banks will open the earnings stands as soon as this Friday, and expectations there are not that brilliant, to be honest with you, because the interest rate environment in the last quarter wasn't favorable due to a rise in the yields. Now, the net interest income may have also remained limited due to a sluggish loan growth due to high rates. The non-interest revenues, on the other hand, were probably mixed, and that's due to a slowing economic activity, and also how these credit that could remain a place to watch, especially given the fears that we have today around the commercial real estate, as the first interest rate cut from the Fed can't come soon enough to ease pressure in this closely watched and troubled sector. So the S&P 500's financial sector has been stagnating since its mid-May peak, and bad news on the earnings front could lead to a further divergence with the S&P 500's index, which is driven higher by the technology stocks and the AI craze. And that would leave the S&P 500's rally further narrowed, and the potential of further and sustainable gains more vulnerable and more difficult. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.